Good morning. This is Barry Knapp from Ironside's Macroeconomics. It's Monday morning, April 22nd at about 7:10 a.m. Mountain Time. This is the introductory version of our weekly audio and video summary of our note, which is our marquee product. The note this week, released on Saturday morning, was titled Unhealthy Broadening Out. There's 5 sections to the note. The core theme is a little tactical this week. We do think we could get something of a relief rally this week as attention turns from macro data to earnings reports. And because we thought earnings season could be characterized in 3 waves, the first one being not so supportive for the markets, financials and their weakened profitability. Not a credit problem like 2008, more a profitability problem like 1980, the last time we had this deep a yield curve inversion. But then it would move on to industrials and tech, and that'll be in focus this week. The 2 important numbers we get at the end of the week, GDP on Thursday and PCED on Friday, we already have most of the inputs to those, so the probability that they provide a big macro surprise that either tends towards 5%, an outcome we think is reasonably probable or more probable than not, is fairly low on this week's data. But next week, we've characterized the subsequent week, not this one, the one after, as the point when the chaos could hit the fan. That's a reference to an old Lehman Brothers colleague of ours who had a propensity to mix metaphors. So this week, again, with earnings season coming in, reasonably favorably thus far, that should provide some support for equities. It's why S&Ps are up about 30 handles so far this morning. We do have an ongoing bank profitability problem. However, industrial sector earnings have been beating results decisively, with about 10% having reported. Expectations are relatively low, even though the sector has cyclical and secular tailwinds. It is expensive, but if we're looking at a manufacturing renaissance that goes on through the decade, those valuations are probably justified, and that's why it's one of our bigger overweights, or our biggest overweight, actually. And tech, their expectations are higher. Stocks have come down recently, and we think that'll probably go reasonably well. Also, when we get to the subsequent week, though, is when the chaos could hit the fan. And that's the idea that we're going to get labor market data. We're going to get the employment cost index. That'll be the last big number. And we do have a deep dive into that in the note, trying to make the point that the immigration surge, the increase in labor supply that the Fed has found some comfort with, that we're not going to have a wage price spiral, is really only impacting the lowest quartile of wages. And we walk through that in the note. We don't think it's putting downward pressure. That employment cost index is the most robust of the big wage indicators, those being the Atlanta Fed wage tracker, monthly average hourly earnings series, and then of course employment cost index. So that will be a big number. But also that week, the morning of the FOMC meeting, we're going to get the quarterly refunding announcement from the Treasury. That's had a bigger impact on the Treasury market than has the actions of the Fed in the last couple of years. And so that is, of course, a very big deal. If they don't, they choose to issue more coupons, that'll put more pressure on the market. This week, we do have a lot of supply in the belly of the curve. We described it on CNBC last week as potentially having a bellyache, meaning the auction of 2s, 5s, and 7s doesn't go particularly well because the banking system is going to be reluctant to take down those securities, given they have very limited visibility as to when the Fed would cut to 4%, the level we would think would painlessly disinvert the yield curve. So moving on to, of course, the FOMC meeting and then the employment report that Friday. That could be the point when we get the data that tends towards 5%, and we get an unhealthy broadening out where everything gets caught into this correction, not just small caps and banks. Last week, we got a little preview on Friday of what happens when tech gets drawn in, but we think we could get, if we go to 5, and that, again, we think is our essentially our base case, that's when we could get the unhealthy broadening out. So also in the note this week was a detailed discussion of financial conditions, the difference if you're a floating rate borrower versus a fixed rate borrower. Fixed rate conditions could get tighter if we're right and tens go to 5 or beyond, which is where they probably should be. But then if you're a beneficiary of fiscal stimulus, conditions are decidedly loose. And this is at the core of why there's all this confusion about whether financial conditions are loose or tight. And then we just wrapped it up with our broader market call, the idea that we could very well be in for a little bit of a deeper correction. If we do get down 10%, chances are we'll be using that as an opportunity to put some money to work. But that's a story for another day. So that's it for me this week. Barry Knapp from Ironsides. And by all means, if you'd like to get a trial of our full notes, let me know. Send me an email. We're happy to do that. Barry Knapp, Ironsides. Have a good week, everyone. Thank you.